evening, good morning, and good 2020. This is always one of the high points of the year. I don't know if it's the past year or the next year, but we'll take it for what it is. A surveillance special, a look a year ahead to 2020. We're always trying to find someone with experience, with perspective. They've been right, they've been wrong. We could do no better after this most interesting 2019. And ABBY JOSEPH COHEN. She's senior investment strategist at Goldman Sachs. That barely describes her contribution to the American financial system, her work with the CFA Institute, among others. And again, an extraordinary year to look forward to. Abby, thank you so much for being with us. There's much to talk about in the next half. I want to talk about your new effort, thinking about immigration, what it means for the fabric of the nation. We must talk about the central bank. But we've got to talk about the markets. You have been the gloom crew's great piñata. They love to go after ABBY JOSEPH COHEN. Good times, bad times. We can't possibly go up. And once again, confounded not only off the gloom of last December, but confounded over 1 year, 2 years, 5 years, 10 years to good and substantial equity returns. When does it end?
Well, Tom, thank you, first of all, for having me here for this discussion. The gloom at year-end 2018 in many ways set us up for a good start to 2019 in the markets. And one of the things I'm concerned about is just how happy everybody is at year-end 2019. I think what's priced into the market right now is an economic scenario that seems to be the most likely. No recession, the economy perking up a little bit, corporate profits in mid-single digit, maybe a little bit higher growth, but it's priced into the market. And what I worry about is when valuation is already there, the risks could in fact be to the downside rather than the upside. The base case is for mild returns, not just in the United States, but several other equity markets. Let's call it mid-single digit, along with the expected profit growth in 2020. But there are a number of things on the horizon that could push us askance, and with valuation where it is, there's no margin for error.
I want to talk about the idea of a correction. It seems it's impossible to go down 10%, and maybe for a blink we go down 18%, but we've forgotten what it is to go down. A huge theory of the gloom crew now is that if we get to enough down, there'll be panic selling, which will take us down further. Do you buy that idea?
Well, let's add to the panic selling the whole concept of the structure of the market, which has become increasingly dependent on ETFs and other things which are index related, especially market cap weighted indices. And so if there are in fact declines of the sort that we saw in November and December 2018, that in fact takes on a life of its own, because the stocks that are most heavily sold are the most liquid stocks and the stocks that have performed the best. And I think in 2020, investors need to be thinking about the stocks that didn't have the good price momentum thus far, but offer good value. What we're seeing in the equity market right now is an almost unprecedented spread in PE ratios, where there is a group of stocks where PEs are very high, but there are also a number of stocks where PEs are on the low side. And maybe that's where the best opportunities are for portfolio protection.
Even on a year-ahead view, we've got to get out of the way, well, the housekeeping here of what we're doing, and that is dividend growth, share buyback. Does it continue? The use of cash story, does it continue?
Share buybacks have been such an important part of the story for the last several years, and there are some signs that it could be slowing. And one of the things that has always troubled me about share buybacks is that companies are using their cash to do this and for special dividends and to raise regular dividends. But we have also seen that the percentage of cash being used for future growth in the form of CapEx and research and development and so on is actually not at particularly good levels. And that worries me because it says companies are not really seeing good reinvestment opportunities.
You put together a terrific PowerPoint year-end for some of your clients, and part of that is about the uncertainty that's out there. It's about the lack of spending. Let us go to what Goldman Sachs looks at, which is business investment. Link in the current news item, the trade war, with a dearth of business investment in the future out a year in terms of owning equities.
it's no secret that CapEx, business fixed investment, was disappointing in 2019. In fact, it was negative, and we think this will continue in 2020, especially for structures. And when we talk to companies about why that is, many of them do point to the uncertainty of the trade battles. We see this not just in the United States, by the way, but trade policy uncertainty is actually more dramatic in some other countries as well. And what we basically see is companies are not sure about where they should be investing for their supply chains, and so they're just kind of sitting on their hands right now. Well, that's not good for long-term economic growth.
I'm going to predict in 2020 there will be a new study of what globalization means. What does, for multinationals and the kind of big companies we are comfortable buying right now in the U.S., what's the new globalization that ABBY JOSEPH COHEN sees?
Well, the new globalization is one where there's a very significant impact from political forces in many countries. We're seeing a pushback not just in the United States, but in many other nations, and I worry about it because we have had, since the end of the Second World War, this period of multilateralism, not just in terms of trade and economic relationships, but also in terms of political and military alliances. And 2020, I think, could be a year where we see these things breaking further apart, and that does disturb me in terms of what the long-term consequences may be.
I want to go to the more granular view here and the call on international. Certainly what we've seen in interview after interview of Bloomberg surveillance is, well, the percolation of international EM currencies seem to do a little bit better. The chart of the Morgan Stanley International Index and all, U.S. up, international flat. Does that change next year?
If we take a look at the forecast from my Goldman Sachs colleagues around the world, when we look at the developed markets, we're not really seeing much differentiation, basically mid, maybe high single-digit returns from equities, depends upon where this year ends. Right. But it's really tied to profit gains. Where we see more valuation opportunity is, in fact, in the emerging markets. But let's be very careful. The emerging market indices are now heavily dominated by China. So very often when individual investors say, I want EM exposure, make a careful decision about whether you want that exposure to China or whether you want it to EM ex-China.
Well, all of this is driven by revenue. If you go up the income statement with a low interest rate regime that we've got now, as we mentioned, stocks for 2019 doing well were revenue growers is a general statement. Apple's an exception to that rule. We seem to be desperate to buy revenue. We seem to be desperate to buy nominal GDP. Does that end next year?
We also seem to be desperate to buy earnings growth per se. And one of the things that I'm glad you point out the difference between is that a good deal of the earnings growth for some companies has really come about because of the reduction in the corporate tax rate. That's not what we want to pay a lot for. We do want to pay for revenue. And we take a look at some of the categories that have not performed well. You know, we all know that technology stocks have been outstanding stock performers in the U.S. markets. One of the reasons the U.S. has outperformed other markets is because we're more tech-heavy than the indices in other countries. But when we take a look going forward and we say, okay, we don't expect a recession, we expect a modest improvement in GDP to 2% or a little bit better, that basically pushes us in the direction of some industrials and some others that have not performed well. My colleague David Costin makes a very strong point about why we want to look at companies that offer growth, but growth at a reasonable price.
I want to, as we close out this discussion of equity, and we'll talk Fed here in a moment, folks, I really want to focus in and drill into the idea of this equity outperformance and the gloom that's pervaded. It's been a single-digit world, but it's not. SPX back a long time, 9% return. It seems like we were too cautious over the last 10 years. Should we maintain that caution, or can we begin to lift our single-digit expectations?
I find myself to be more cautious than I was, and it's strictly driven by valuation. In the worst part of the Great Recession, what was priced in at those PEs of 8 times earnings was basically the assumption that the profit recession would last another 3 to 5 years. What's priced in now at a PE of 18 times earnings is the assumption that there will not be a recession, that profit growth will continue, and so on. So there's no margin for error. And that's what I'm always looking at. Could there be surprises? Will those surprises be positive or negative? And as I take a look at things now, I believe that we have a chance of more negative surprises than positive, including things that happen outside the United States.
I've got about 8 more questions on the markets. I'm going to squeeze them in with our discussion on the Fed. We're going to do this. I'm going to come back with Abby Joseph Cohen of Goldman Sachs, drive forward to the Fed, and then a really special section here on her current research. Please stay with us. This year-ahead view for Bloomberg Surveillance. Welcome you, Bloomberg Surveillance, a year ahead, and we are thrilled to bring Abby Joseph Cohen, of course, senior investment strategist at Goldman Sachs, and so much more to the American financial system. Again, I mentioned her work with the CFA Institute over the years. Abby, the market's fine, and it devolves into Fed policy. Are we done with the dots? Can we bury the dots in 2020?
I think we're not going to be paying as much attention to the dots.
Thank you.
Because we think that the trend in interest rates is basically flattish in 2020. But here's the thing to look at, Tom, and that is just the way we have seen this decompression of PE ratios in the equity market, we have seen a compression of yields in the bond market. And we see the compression in terms of the term premium, that is the duration of the bonds, where longs are not yielding much more than shorts. We also see this compression in terms of quality, where lower quality bonds aren't yielding much more than higher quality bonds, and so on. And I find this disturbing.
It's very different, isn't it, to say the least?
It's very different. And keep in mind that those people who argue that equity valuation is just fine because of discounted cash flows and so on are basing those numbers on interest rates that are at historically low levels. If interest rates were to start to move up, there in fact would be an impact on equity valuation.
This isn't in the textbooks. I mean, Chairman Powell, Fed official, and frankly the new governor of the Bank of England and others have to deal with a material world that is not in the textbooks that we studied. How unusual is this world, and do we go back to what we knew, or do we go beyond to something that we're making up as we go?
This is an extraordinary period in economic history. When I was a junior economist at the Fed, we were fighting inflation, and we continued to fight inflation for many years, and now the fear is that we're fighting deflation. Now, let's be clear. In the United States, there is not deflation. Right? Wages are rising. Most importantly, goods inflation is moving up as well. Where has there been deflation? There's been deflation in places like Japan, but it is not really that common. So why are interest rates as low as they are? In many cases, it's because it's the single most used policy tool in many nations. In Europe, for example, there's not been much use of fiscal policy for stimulus reasons. That has to do with the compact that put the EU together. And so we have a situation in the United States where our interest rates are being held down in part because interest rates are negative in other countries. If you are an investor based in any number of developed economies, you say, I don't want my negative yield on my own country's 10-year. You buy the U.S. Treasury.
You're getting out in front of my calendar here. In January at Davos at the meetings of the World Economic Forum, my theme is going to be negative interest rates, this experiment. Just, I don't want to get you in trouble here with Goldman Sachs, but is it an experiment that's worn out its welcome? Is it an experiment that was just wrong? Or is there value to this original central bank policy?
So I can explain it as a monetary economist with some experience in that and say, okay, in a financial crisis, the idea was for a short period of time to have negative interest rates. What we're seeing, though, in terms of the implications in the real economy, it's not so pleasant. So, for example, in nations where those yields are negative, people are not spending money. In fact, they're saving more than they did before.
Exactly.
So there's the opposite impact. It's not stimulative. And we, of course, do see the impact in the United States. Our Fed has pushed back against the idea of negative yields, and yet our yields are much lower than they otherwise would be because of what's happening in other countries.
One of our great losses this year in economics was Marvin Goodfriend of Carnegie Mellon with his important Jackson Hole paper. And precisely this criticism of Professor Goodfriend's work is people like you are in the ethereal of economics, talking to Chairman Powell, et cetera, and the rest of us are out there with negative interest rates. It doesn't work. Is Chairman Powell aware that into 2020 that there's almost a social need to normalize rates back to the incentives that we knew?
I have great confidence in Chairman Powell and also with the team that he has, not just the members of the board, but also the staff members. And I think they see the pragmatic aspects of what's happening right now. And I think they would like nothing more than to be in an environment where we have real interest rates return to positive levels, because it's something then that they know how to use as a policy lever. They are in a very awkward position right now. In terms of having very limited policy tools.
But then this is critical, and folks, this goes back to your work in academics with some really high-level mathematics. I mean, I don't know if it's differential equations and all that, but Abby Joseph Cohen folks can do the math. Do we escape out of this central bank experiment with smooth, controllable, stable curves and drift functions and such? Or do you look at it as a 2020 or 2025 of jump conditions in discontinuous moments?
I'm going to change the question a little bit, Tom,
Please.
And say, what are the other issues that are leading to these very low interest rates? Because we tend to focus only on policy tools. And I think one of the things that many people forget about is that we have been in an environment in which this move towards globalization has, in fact, kept inflation lower. We're also in an environment where in many countries, population growth is extremely slow, if not stagnant. And what actually gives us long-term economic growth? It's population growth. And if population is not growing in Japan, and it's not growing in China, very importantly, and there's extremely sluggish population growth in Europe, maybe we can understand better why those economies have slowed, why there are some signs of deflation elsewhere. The United States has been fortunate. We have had among the fastest rates of population growth, and we have to point out very clearly that about half of that over the last decade has come from immigration.
Yeah. This is so important. Abby Joseph Cohen with us to drive into 2020. Of course, it is an election year. And part of that will be the fabric of the nation. As Abby mentioned, it's the idea of the people of the United States of America. She's been looking into that. Coming up on this year ahead, Abby Joseph Cohen on immigration. This is Bloomberg Surveillance. Welcome all of you again, a year ahead. Bloomberg Surveillance, we love doing this every year. Our team tries to put together a good conversation, and that is easy with Abby Joseph Cohen, because every time she walks in the door here at our world headquarters, I know there's new research, and you go to where Henry Kissinger is, which is the fabric of a nation, is about immigration, migration, the demographic trends that are out there. What did you learn in your study?
Well, clearly, Tom, ours has always been a nation of immigration. And there's been so much noise in the discussion over the last few years that we need to really look at the data, which is what we've done. And one of the key observations we've made is this. Over the last 10 years, because the native population is getting older, there's a lower birth rate, there's a higher death rate, and in fact, about 50% of the growth in our labor force and our population is now coming from immigration. And that's something that really is the lifeblood for any nation's economic growth. The nations right now in the world that are struggling are often those with extremely low birth rates and in some cases stagnant population growth.
There has to be a policy. In my life at Bloomberg, I've seen many policies succeed, go down in flames upon vote in Washington. How do we get something voted on that benefits all?
looking at the economic dimension, we've identified some things that are really important for the United States. So, for example, when we take a look at those people who have doctorates in things like engineering and computer science, who are working in U.S. industry, something on the order of 40 or 50% of them are immigrants.
Are they taking jobs from Americans?
They are not. We have had conversations with the American Academy for the Advancement of Science, who basically said the problem here is that we have an inadequate pipeline. We're not training our kids at a young enough age, K through 12, to be interested and strong in math and science. By the time they get to college, they're already behind. And when we take a look at graduate school, what we see is about 60% of the students in master's and PhD programs in the applied sciences and engineering are in fact immigrants. Now, here's my concern.
Please.
While there's been all this discussion about unauthorized immigration, and clearly we understand there are issues associated with it, we're also now seeing a decline in authorized immigration. So, for example, since 2015, there has been a notable decline in the number of foreign students coming into the United States. There's been a 20% decline in the visas that we issue for people coming in for specialized employment. And so I worry that we are harming ourselves. We need to be filling that native pipeline. We need to be improving education. But in the meantime, we're hurting ourselves.
Well, let's take a famous Goldman Sachs, ABBY JOSEPH COHEN scatter dot chart. There's a scatter dot chart out there. I don't have it in front of me, folks, and it's got all those dots linking lower quintile, lower quartile, low-wage jobs, and it folds right into consumption and then folds right into nominal GDP. That linkage is still there, isn't it?
That linkage is still there, and recent data from the Commerce Department shows something very interesting.
Please.
The fastest growing job categories in the United States tend to be those which are filled by immigrants. And they fall into two categories. There's the high-skilled jobs, think of it as IT, engineering, and so on, advanced healthcare. And then at the other end are things like accommodation and retail trade and food. And these two sets of categories both tend to be overrepresented, if you will, by immigrants. And the household formation we see from immigrants represents about 43 or 44% of the total over the last 10 years. When households are formed, they buy homes, they furnish those homes, they pay property taxes and so on. So there really is a very important ecosystem associated with this.
What is the compare and contrast here to Europe and other? I mean, I think of almost a McKinsey study. It could be a Goldman Sachs study as well. But there has to be a compare and contrast. What's our best practice on immigration when you look at other nations and how they're tackling the same fears?
Yeah, so other nations are dealing with things in a somewhat different way. The United States historically is quite different from other nations because other than the Native Americans who are here, we are all immigrants, some forced through slavery, but we are all immigrants. And so we have had over the last 200 years cycles in terms of immigration policy, sometimes extremely welcoming, and sometimes perhaps when there is perceived economic duress or there's some political advantage to be taken, that's when we see the periods of restriction. What we have seen that now distinguishes our history from ourselves has been the attitude we're taking towards refugees. The United States previously had always been one of the most welcoming nations towards refugees, and now not so much.
ABBY JOSEPH COHEN of Goldman Sachs. Love doing this. It's a year ahead view, and we've done this with ABBY JOSEPH COHEN, Senior Investment Strategist at Goldman Sachs. We hope for all of you it is a wonderful 2020. I can't promise you the equity returns of last year. Maybe we'll get half as much this year. This is Bloomberg Surveillance.